Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello, and welcome back to another episode of Reverse Mortgage Radio, where I help clear the confusion, cut through the myths, and help you discover the real benefits of the home equity conversion mortgage, better known as reverse mortgages. That's what most people know it as. I'm your host, Bruce Simmons, and I've been helping Colorado homeowners navigate through this powerful tool for over 22 years now. And let me tell you, I swear, I absolutely love what I do because it really changes lives. Today, I'm going to dive into the three biggest concerns that I hear all the time from homeowners, and a lot of times from their adult children as well, when they first start looking into reverse mortgages. And what I did is I went to ChatGPT to find out what the three biggest concerns people have about reverse mortgages. What are their biggest fears? And we're going to talk today about fear of losing the home. That's one big fear people have. The second fear is that their kids are going to be left with the debt. And the third one is, aren't reverse mortgages too expensive? They're not worth it, right? Well, we're going to dive into that in just a minute, but if you have any questions about reverse mortgages, you don't know who to call, you can call me. My name is Bruce Simmons. I'm the reverse mortgage manager for American Liberty Mortgage here in Denver. You can reach me directly at 303-467-7821. That's my direct line, 303-467-7821. And you need to give me a call if you have any questions about reverse mortgages. Even if you have a reverse mortgage now and you're not sure how it works, because that does happen. I know years ago I met with a lady and her daughter because I did a loan for her and her husband 7, 8, 9, 10 years earlier. And then the husband passed away. And the daughter got involved in the mom's finances and was like, what is this reverse mortgage? And I went down to Aurora and talked with them about it and explained how it all works and everything. I stay in touch with my customers. When you do a reverse mortgage through me, I'm local here in Denver, even though the statement comes from a company out in Lansing, Michigan or Texas somewhere, you're still my customer. I always tell everybody that. As long as I'm in the business, and I've got another probably 8 to 10 years left at least before I'm able to retire. Who knows? If interest rates don't change at all, I may never retire. Now, I plan to at some point. I just don't know when. Now, you can also reach me online at reversemortgageradio.net. Next week, this show will be up on my website, and it's on some other platforms. I don't know which ones, but you can go to my website at reversemortgageradio.net. Reversemortgageradio.net is my site. You can download my free consumer guide. I've got a free guide there that has like probably too much detail in it in this booklet that I have. You can also go there and get a free quote. And your information is not sold. I'm the only one that has it. I don't ask for social security numbers or anything like that. You can download the information. You can watch videos, testimonials from other customers, real live customers here in Colorado that have done reverse mortgages and are very happy with them. That's all at reversemortgageradio.net. Okay, let's jump into today's program. Let's talk about the first fear. Now, this is through ChatGPT, and also it's my experience, I would say, because most of the people still, I met with a lady last night, and it was a referral from a real estate agent that I know. And this customer or this lady called the real estate agent yesterday afternoon and said, I don't think we want to meet because I want to give the house to my kids and I want them to have the house. And I don't want to give the bank the house. And the real estate agent explained, no, let's meet because I think there's some misunderstandings here. And that was it. She was afraid of losing her home. She thought the bank was going to take her home or that the bank was going to own it. And I think looking back, these ideas or these thoughts that people have about reverse mortgages, they can date back to old stories well before the 90s. See, FHA got involved with reverse mortgages in 1988, actually, is when President Reagan signed the bill that authorized the Federal Housing Administration, overseen by HUD, to insure reverse mortgage loans. And they set up a lot of different rules. This is the most regulated loan you'll ever come across. And in 1989, the first FHA insured reverse mortgage loan was closed. That was the Home Equity Conversion Mortgage, or it's also called a HECM, HECM. That's just simply the name of the FHA insured reverse mortgage loan, which is the most popular loan in the country. In Colorado, probably my guess is about 97% of loans, reverse mortgage loans, are closed through this program. Other loans that are not FHA insured are loans for condos that are not FHA approved, and also high-valued homes, because FHA puts a cap on the amount of money that we're allowed to consider when we loan on a reverse mortgage. But some people in Colorado now, in Boulder County or up in the mountains, they have multi-million-dollar homes. And so a reverse mortgage doesn't really work for them. The FHA-insured reverse mortgage does, but a reverse mortgage concept does. So we can do non-FHA insured loans for these homes that are $2 and $3 and $4 million, or for condos that are not FHA approved. There's a number of condominiums in the state that can't or don't want to jump through all the hoops that FHA makes them jump through in order to become an FHA approved condominium complex. But the thing is that there's all these older ideas that people have from reverse mortgages. And they've changed a lot over the last 15 years, especially, or I should say specifically, from 2009 to 2019. That 10-year time period there were constant changes and improvements to the loan. Some improvements we like, some we didn't, because they are kind of overbearing. And some, they're better for the long run, but not necessarily the short run. The way the HUD changed the rules on the amount of money we can loan is better for the homeowner and the program in the long run. But today, if you're calling me and you say, hey, I want to get a reverse mortgage and I'm 62 and we can only loan a third of the value of the home, you're like, well, that's chintzy. Why don't we make it 50 or 60% of the value at least? And that's the way it used to be, but not anymore. That's some of the changes that we came across, because we found that if there were a downturn like in 2008, then people were upside down too quickly. They ran out of equity. Now, that doesn't mean the bank takes the home, because the bank does not take the home as long as you live in the home as your primary residence, as long as you keep your name on title, you pay the property taxes, pay the insurance, and maintain it. You do those 5 things, you can never, ever, ever lose your home. And even if when you pass away, you no longer live in the home, your heirs inherit the home. That's one of the biggest misconceptions people have. They think the bank takes the home when you die. Just not true. The heirs inherit the home. Now, if the heirs don't sell the home, or if there's no equity left, they can just sign the house over to the lender. But if the heirs don't do anything, they don't refinance the debt or pay it off, then the bank has no alternative, but because their only option to collect on the loan is through the sale of the home. So they either have you sell it, you pay off the bank, and whatever equity is left to you as the heir, or if that's not going to happen, then they'll foreclose, they'll sell it or pay whatever they can get for it, and then the rest is going to be paid for by mortgage insurance. All FHA insured loans have mortgage insurance. And that's the beauty of that, is that they can never, ever, ever come after you, your estate, or your heirs for additional debts. And we'll get into that in the next topic. But the title stays in your name as the homeowner. When you get a loan on your house, you go to the bank and you get a regular mortgage. All you're doing is you're signing something that says, I owe the bank $200,000 or $500,000 or whatever it is. You owe the bank money. The bank places a lien on your home. It's called a deed of trust in Colorado. And that deed of trust shows that that you owe the bank money. When you pay the bank off through 30 years of making payments, then they release that lien. You get a release of deed of trust that gets recorded in the county records, and that lien gets paid off that way and released. The same thing happens with a reverse mortgage. When you get a reverse mortgage, it's simply a loan. The bank is not taking the title to the house. You're not giving up title ownership at all to the house. And then the bank places a deed of trust on the home, just like a regular bank does for a regular mortgage. You don't have to pay, though. That's the big thing. No required monthly payments. However, you're still charged interest. The house is still yours. You can paint it purple. You can add a bedroom. You can sell at any time. When you sell, just like with a regular mortgage, you have to pay off the existing loan on the house. So you sell the house for $500,000. You owe $200,000 on the mortgage. The buyer gets a new loan on the house. They pay you $500,000. The first $200,000 has to go to pay off the existing mortgage. That's the same no matter what kind of loan you have against the house. A forward mortgage, a HELOC, a reverse mortgage, all of those are the same. Then you keep whatever equity is left, just like a regular mortgage. So whatever equity is in your house is still yours. And the equity in the home is just the difference between the value of the home and the balance owed against it. If you have a $500,000 home and a $200,000 loan against it, you've got $300,000 in equity. And we loan, the reverse mortgage, we don't loan based on equity. A lot of people think that. They'll call and say, hey, well, I've got $500,000 in equity on the house. How much can I get? And I say, well, it depends on the value of the home, because FHA dictates to us, the lender, how much we can loan based on the value of the home, the age of the youngest homeowner, and the interest rate. The higher the interest rate, the less money we loan as a percentage of the value of the home. The younger the homeowner, the less money we loan as a percentage of the value of the home. So think about it this way. If you're 62, you could very well live in that home for another 30 years. And because you're still charged interest on the loan, the interest accrues if you choose not to make payments. You certainly can make payments, and more and more people are doing that now. But for a long time, most people do not make payments. The interest gets added to the loan balance. And every month you get a statement in the mail, or you look at it online, and you're going to see that loan balance getting bigger and bigger and bigger because you're not making the payments. So you don't have to pay every month. You're keeping that money in your pocket. As a result, the equity in the home, I should say the loan balance, grows over time, because the interest you would normally be paying out of your pocket, the $1,000 in interest and principal every month, is now being added to the loan balance. So your loan balance is going up now by $1,000 a month. And that's a very simplistic way, because it does compound. So 30 years from now, you could end up owing a lot more money than you do today. And if the value of the home does not appreciate the way we think it might, we usually use a 4% appreciation rate, because that's pretty average. Sometimes it's a whole lot less. Sometimes it goes down to a negative. Sometimes it's 10 or 12%. But on average, it's 4%. So if the value of the home doesn't appreciate the way we think it does, you could end up upside down on the house. Now, you're protected because of the mortgage insurance, so you're never going to pass a debt beyond the value of the home to your estate. But we don't want that to happen. We want you to keep equity in the home. So we reduce the amount of money we loan the younger you are. Now, if you're 90, odds of you living there another 10 years are pretty slim. Even if you live to be 100, you might not live in the house. You might only live in the house another 5 years, say, and then you have to move to assisted living. So we can loan a lot higher percentage. We might loan 60% of the value of the home, or 65%. of the value of the home if you're 90 or 95, because you're not going to live there as long. And so the odds of the interest accruing over a long time period is very low. The same thing with the interest rate. The higher the interest rate, the faster the loan balance is going to appreciate or grow. So if it's growing at 10%, if the interest rate's 10%, we're going to reduce the amount we can loan because the interest accrues at a faster pace and it chews up the equity at a faster pace. Whereas if the interest rate's 3%, we're going to loan a lot more because the interest is going to accrue at a much slower pace. Okay, that's a quick overview there. But just remember, for this first fear, losing the home, it's your house. It will be your house for as long as you live in the home. As long as you live there, you pay the property taxes, pay the homeowner's insurance, maintain it, and keep your name on title. Then at the end of the loan, your heirs inherit the home. The bank does not take the house. Okay? Keep that in mind. Now, just real quick too, a quick example, because I remember back in like 2003, I think, I did a loan for a lady. She lived near Cherry Creek High School. Nice patio home type situation. And she was so sure the bank, I told her over and over, and I explained to her, I showed her in writing, it's just a loan, but she was sure she was giving the bank the house. She owned it free and clear. She worked really hard to own this home free and clear. And she felt like a failure because she lost money in the dot-com bubble. And she just felt like she didn't have enough income to be able to retire. Well, we did a loan for her and paid her money every month. I don't remember the amount because it was so long ago. But I remember she cried at closing, not because she was happy, because she felt like she was giving the bank her house. She felt like she was selling it. That was not the case. More than a decade later, I think it was like 2014 or 15, she called and wanted help to cancel the payment that we were paying her. She knew the loan. She couldn't pay off the loan, but she wanted to stop the payment because she didn't need it anymore because her other investments had panned out way better. She learned from her losses that she took in the dot-com bubble, and she made money, and she said, I don't need to receive a payment anymore. She kept the loan going, and I don't know what eventually happened, but she was so happy. She said, yes, I am so happy I did this. It saved me. It saved my house. And over time, I eventually came to realize it's still my house. I could do whatever I want with it. And so she was very happy with it after a while. It took her a while. Now, most people, they're happy when they close the loan. Now, that was kind of a weird situation. But it took her a long time to realize the bank does not own the house. All right. Now, we already talked about the second one, but before I get there, I do want to remind you are listening to Reverse Mortgage Radio. We're talking about the 3 biggest fears people have about reverse mortgages and what stops them from researching it to see if it's the right situation for them. And that's what we're talking about today on Reverse Mortgage Radio. I'm your host, Bruce Simmons. I'm the Reverse Mortgage Manager for American Liberty Mortgage here in Denver. You can reach me directly with any questions about reverse mortgages at 303-467-7821. 303-467-7821. You can visit me online as well at reversemortgageradio.net. reversemortgageradio.net. Okay, number 1 fear, people are afraid they're going to lose their house. That doesn't happen. Fear number 2, their kids will be left with a debt. And it's funny, not just that. That's like the main fear, but other fear that you're not going to leave anything for the kids. I met with this lady last night with the realtor that I mentioned earlier. She owes about $200,000 on $1.5 million home right now. And she's like, well, I've always wanted to give the house to my kids. And her daughter and son-in-law were right there, and they're very, very well off. They're very successful. They own multiple businesses, and they don't need it. And she also, the homeowner, owns a couple rental properties too, and she just can't sell them right now is the problem. But anyways, we talked, and I don't know if she's going to move forward or not. But the thing is that with the protections that are in place for this loan, remember, this is the most regulated loan you can have. There are so many regulations to protect you. They also protect the lender, the mortgage insurance really protects the lender, which indirectly protects you, your estate, and your heirs. Let's say you don't have $1.5 million home. Let's say your home's $500,000 and it's the only place you own. You have a $100,000 mortgage on it, and it's, you're going to end up, you still got 20 years left to pay on it, and you're 70 years old. You're probably going to be paying on it for the rest of your life, and you want to live a better life. Maybe you can afford to pay the payments now, and you've got some money in savings, just not as much as you'd like to feel comfortable. So you do pinch pennies, you budget, you don't take trips that maybe you'd like to. Maybe you're not as active as you want to because you're trying to save that money you've got in savings. You got to make the mortgage payment. That's what drives me crazy. And I'm going to go off on a little tangent here because people say reverse mortgages are risky. I should have put that in there. No, what's more risky? Having a loan on your house that you never have to make a payment on as long as you live in the home and pay your taxes and all that. Or having to pay a $1,000 mortgage payment every month on a $2,500 income or a $3,000 a month income. Which is more risky? If you don't make that $1,000 payment, you could lose your house. You'll be out on the street. Your credit will be wrecked. Or not having a mortgage payment and keeping all the money in your pocket and only having to pay your property taxes and insurance. I don't know. Which is more risky? A conventional mortgage is way more risky for people that are retired and living on a fixed income than a reverse mortgage. Okay, got that off my chest. And also, you're not going to leave a debt to your family. There's mortgage insurance on all FHA-insured reverse mortgage loans. Well, even non-FHA-insured reverse mortgage loans, they have what's called a non-recourse feature. All reverse mortgages are non-recourse. The lender can never, ever, ever come after you, your estate, or your heirs for any loss that they incur. If it's an FHA loan, the lender doesn't even take a loss because if they lose money on the reverse mortgage, or they would lose money, the mortgage insurance pays them. And since they're not losing any money, they're not coming after you, your estate, or your heirs. Okay, it's called non-recourse. And with a conventional reverse mortgage loan, proprietary is what they're called, that kind of protection is built in the interest rate. They charge a higher interest rate because they're not collecting mortgage insurance. So that you have to be aware of that. And the risk, obviously, the way the reverse mortgage works is you're charged interest. That interest accrues over time. And as that interest accrues on the loan balance, your loan balance gets bigger and bigger and bigger, and eventually could exceed the value of your home. But no, they cannot even kick you out if in that situation. Let's say 2008 happens again, and suddenly you find yourself upside down on the house. You owe $600,000 and your house is only worth $400,000. It doesn't matter. As long as you pay your taxes and insurance and live there, they can never, ever, ever kick you out. You can never lose the home in that situation. And your heirs will never be responsible for the debt beyond that. If you pass away owing $200,000 more than the house is worth, that's either the lender's loss and they can never come back to you, or the mortgage insurance will pay it on an FHA loan. Okay. Now let's get to the other one too. Fear number 3 is that reverse mortgages are too expensive. Rumors of high fees. With reverse mortgage, an FHA insured reverse mortgage loan, there is something called mortgage insurance on the loan. All the closing costs are the same as a conventional mortgage, except for the mortgage insurance. The mortgage insurance is what protects you, and it also protects the extra money you have available. So let's say you have this $500,000 home and you're 75 years old or 78 years old. We can loan you $200,000. You owe $100,000 on your existing loan. We pay off that $100,000 loan with a reverse mortgage, and you say, you know what? I'm good just living on this $2,500 a month. I don't need any additional income. So I'm just going to leave that $100,000 there as a cushion. That's called peace of mind. Having that money available that you can draw on at any time if your furnace goes out, if your car breaks down, if a family member needs money for an emergency, or you find a great deal on a cruise to Alaska, whatever it may be, you can use that money, not pay taxes on it. It doesn't affect income or your Social Security or Medicare, but it's there for you. Well, what if the lender goes bankrupt? What happens then? Guess what? You've got mortgage insurance on the loan. The mortgage insurance protects that money that's available. FHA steps in and they agree that this money's available to you. So you find out you need a new furnace. It's the coldest day of the year. It's 20 below and your furnace goes out. You call the furnace company. It's going to be $10,000. But then you get a letter in the mail the day before and it says your lender's out of business. Uh-oh. That $100,000 is gone, right? No, it's not. The government protects that. So that money's available to you guaranteed. Even if you're upside down on the house with FHA, it doesn't matter. It can never be closed out. The line of credit can be closed out on a proprietary program, but 97% or 96% of the loans in Colorado are FHA insured. And if you've got a $5 or $6 or $7 or $800,000 home, most likely you're going to do an FHA loan. And anyways, that line of credit is 100% guaranteed. So if your lender ever goes out of business or they get hit by a tornado and they can't service the loan, FHA steps in and they take care of it. That's the way the program works. That's part of the mortgage insurance. The other part is if the interest accrues over time and it exceeds the value of your home because your home goes down. So now you owe $600 on the reverse mortgage and your home is only worth $400. You still have access to that line of credit. You still have $20,000 left over in the line of credit. You can use that money. And you're never going to pass a debt to the estate when you pass away. Odds are the value of the home is going to bounce back. If you're only in your 70s, say, and you live there another 10 or 15 years, the property value is probably going to bounce back like it did in 2008. Because it dropped in 2008 and then it came way back in 2012, 13, 14, 15, 16, and then obviously in 2020, 21, all that. So you're protected with the reverse mortgage. That's why they're, quote unquote, air quotes here, expensive, because there's cost for that mortgage insurance. But that mortgage insurance provides you so much value. We wouldn't be able to loan you as much as we can without that loan or without that mortgage insurance. Plus, it protects the line of credit. It protects your estate if ever you end up owing more on the home than it's worth. It also provides the regulatory oversight, if you will. Because FHA is involved, they charge this fee, and the taxpayers aren't having to pay for it. You, as the homeowner, are, but it's not out of your pocket. It's all these closing costs are rolled into the loan. So please call me with any questions about reverse mortgages. My name is Bruce Simmons. You can reach me directly at 303-467-7821 or visit me online at reversemortgageradio.net. reversemortgageradio.net. And I'd love to talk with you about your specific situation. This is an FHA insured loan, and there's all kinds of protections for it. If you have fears about it, call me. If I don't put your fears at ease, you don't decide, you don't do the loan. But you're making a decision based on accurate information, not rumors or fears. All right? Keep that in mind. Hope you have a great day and take care of yourself.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.